The following video is intended for candidates interviewing for business, operations, data, or financial analyst roles. Your recruiter will let you know if your interviews will include case interviews. This video is designed to show you what an analyst case at Capital One may look like. Candidates should not expect the same content in their on-site interviews. Capital One has conducted case interviews for analyst hiring since our founding in the 1990s. As Capital One continues to challenge the status quo in financial services, we keep drawing from what has made us great in the past, hiring great people and giving them the chance to be great. In our analyst casing process, we look for candidates who think powerfully. Our analyst roles require rigorous problem-solving skills. Our cases evaluate how you go about solving problems, not just the specific answers you come up with. We assess how well you grasp the concepts, how well you analyze the data you have, and how well you communicate your results. This video demonstrates a case Capital One once administered for analyst roles. The example gives you a sense of how our interviews work and what may make someone successful in a Capital One case interview. You may note that Capital One cases tend to be more quantitative than the standard case interview, given the nature of the Capital One analyst's role. This example showcases the three parts you would see in a typical case: introduction of the business situation and case framework, calculations based on key concepts and drivers of the case, your recommendation. What is the business decision you would make? Some helpful tips to keep in mind during the case. Take notes on the key information. Ask questions. Show your work as you do it. Talk through your thought process. Let's begin.
Shall we start the case?
That'd be great.
In this case, we will be talking about ice cream.
Ice cream.
Yes. This case is not about financial services. A lot of cases we deal with are not. We find it gives us a better idea of how you think versus how much you know about a specific industry. A lot of problems we deal with on a daily basis are broader than banking.
Interesting.
In this case, you are president and CEO for our ice cream corporation. There's a CFO and a COO, but you determine the business because you own the product and sales. First question, what are the key factors you would take into consideration as you build strategies to grow profits for this company?
Let me take a second to gather my thoughts. Okay, I think I have an idea of some of the key factors, but first, can I ask a couple clarifying questions?
It's a good idea to write down your thoughts and ask questions along the way.
Sure thing.
When you say I own product, I assume that means I essentially own the products we offer. For example, we have chocolate and vanilla, but we could also add swirl.
Yes, keeping in mind that ice cream flavors are well established.
Of course. One more question. You mentioned that I would be responsible for sales, so my job would be to maximize the amount of ice cream we sell.
Yes, keeping in mind that your job is to maximize profit, not just sales.
So I'd be responsible for setting up prices as well?
Yes.
Got it. So, to answer your question, what are the key factors I have in mind? I think the key things I think of are the number of sales we have today, the prices we charge, the cost of making ice cream, the number of sales in the market overall.
This candidate clearly shows his perspective on the concepts. Writing down his answers helps him communicate and recall these later in the case. Let's see how other candidates may have answered this question.
I think about the level of competition and the chance we have to increase sales and profits by changing prices.
This candidate gave a shorter answer.
There are a lot of factors I have in mind. I think about what markets we're in and the sizes of those markets. I'd want to know how many competitors we have and their size. Lastly, I'd like to understand what our price is and how that compares to our competitors and to other comparable goods, like cookies, for example.
This candidate mentioned a broad list of items. The caser will ask more questions, and the candidate should try to focus his answers to identify the most important factors.
That's a pretty broad list, kind of everything that the CFO and COO wouldn't be concerned about. That's a great start. Can you talk to me a little bit about how you might prioritize these, since it might be difficult to keep everything in mind at once?
Oh, sure. The order I listed them in is pretty much the order of importance. What's our number of markets? What's our penetration in each of those markets? And what would happen if we change price?
Let me give you a little background on this. We're already a leading domestic supplier. We're in every market and not looking to add any. We know the competition's fierce, but defined. There are national and regional players. We're not expecting any new entrants into the market or much innovation, just steady competition.
Then pricing would be the most important driver.
I'm glad you mentioned pricing. Pricing is the one factor we can control. We're not looking to enter any new markets, and we know the competition's going to make up their minds, but we can control pricing.
If you have a long list, we may try to focus you in order to dive deep on one dimension of the case and get to a recommendation. This is very common and not something to worry about. Here is an example of how that might happen in an interview.
So, of everything we discussed, changing price is the key factor, because if we change our price, it'll affect our volume of sales and our total profit.
Okay, that makes sense.
So pricing is a key lever since we own that decision. But I have to highlight the role of competition. Not so much who and how many competitors there are, but just the fact that there is competition. If we raise our price, people will switch to other brands, and if we lower our price, competition will react. So we need to understand how that will play out.
Okay, so let's talk about the risk in that strategy.
The conceptual section discusses the key levers that drive upside. There are also risks to any option that you should talk about.
Well, the risk here is a price war. If we lower our price and consumers switch to our brand, competition will just lower price and those consumers will switch back.
What would you do to mitigate this risk?
I'd focus on promotional pricing rather than a permanent price change. Run a discount for a period of time and then return to normal pricing before competition reacts.
So we've gotten most of this situation figured out. Are there any other factors you can think of?
On top of pricing? I think there's an upside to brand loyalty after the promotion ends. People tried our brand when it was priced lower and now they prefer it.
There's one additional concept here, but this candidate is struggling with it. Asking questions helps get the candidate back on track.
One thing I'd like to clarify, are we assuming that ice cream is a non-perishable?
Yes, it is non-perishable.
So, there could be a post-sale effect.
Please explain.
Well, during the promotion, sales go up, but after the promotion, maybe sales go down. People took advantage of the sale and don't have to buy as much once it ends. Does that make sense?
That makes sense.
So, then there's the risk that our promotion eats away future sales and profits. People buy extra while prices are low and then buy less when prices return to normal. Then the promotion doesn't drive as much profit as we think.
When you reach a conclusion, there's no need to continue to ask questions. Assert the insight that you have.
Yes, this is an important risk. Your actions have a pulling forward effect, and through the cycle, your net profits even out some. We'll call this factor stocking up from now on.
This candidate realized a key assumption and quickly reached this concept by discussing it with the caser. Not every candidate will realize this as quickly as this one. As we'll see in the analytical section, some problems are easy and some are more complex. Some have long answers and some have shortcuts. Some candidates get the solution right away, while some candidates need to ask questions. The key is showing the caser you grasp each new concept as the case continues. To recap what the key concepts are: role of promotional pricing, temporary to avoid price war, risk of the stocking up effect.
So far, we've laid out the key concepts in this case. Let's go into some calculations. I'll give you some data and ask you to calculate total monthly profit. Today, we sell cartons of ice cream for $5.
$5 a carton?
Our cost is $1 per carton.
How much of that is fixed or variable cost?
Assume that fixed cost is negligible, and this is all variable cost.
And cost is $1 per carton.
Also, we'll use a very simplified number to make the calculations easier. Assume we sell just 100 cartons each month.
Demand is 100 cartons per month. I should be able to calculate the current profit from this. $5 per carton times 100 cartons is $500 total revenue. $1 cost times 100 cartons is $100 total cost. Subtracting out $500 revenue minus $100 cost is $400 total profit.
Make sure to clearly write equations and calculations. There are often multiple ways to get to a result in a case.
I can calculate per unit profit. $5 minus $1, that's $4 profit per unit. With 100 units, our monthly profit is $400.
There are multiple ways to answer this. Think creatively and solve in the way you think is best.
Now calculate the monthly profit if we run a 10% off promotion.
I think I need more information.
Think proactively about what you need to solve a problem. If you don't have it, the caser might.
How does quantity of sales change when we change prices?
Great question. I have one more piece of data that might help. The elasticity of demand is -4.
Can you explain that, please?
If you don't understand a concept, ask. And if you think you understand it but aren't sure, then explain your view and ask the caser to confirm. The caser wants to work through this with you.
Sure. What do you need to know?
Well, can you define elasticity, please?
Elasticity is defined as percent change in quantity over percent change in price.
Okay, so if price increases by 1%, quantity would decrease 4%, and vice versa for a price decrease. So for this example, if we drop price by 10%, quantity increases by 40%?
You got it.
Oh, okay, well, this makes sense. I should be able to calculate the new profit now. First is the new price per carton. $5 was our original price per carton. We reduce price by 10%, so the new price is $4.50. This makes total revenue of $4.50 times 140 cartons, and total cost $1 times 140 cartons. Let me just calculate this. That's $6,300 revenue minus 140 cost, so $6,160 is our new total profit. Let me double check that. It should not have gotten so much bigger. Let's see. 140 times 4.5 is $630. Okay, well, that makes more sense. So monthly profit in the promotion is $490.
That makes a lot more sense.
Stay organized to avoid mistakes in calculations. Listen to your caser, double-check your work, and correct as quickly as possible. And keep in mind, there's a shortcut here that makes this a lot easier.
Per carton profit is now $3.50. With 140 cartons sold, this is 3.5 times 140, or $490 profit.
So would you recommend we do the promotion?
There's another factor we discussed before, the stocking up effect. Do you have any data about historic stock up rate? I mean, that might help my decision.
For this candidate, having information written down helped to recall an important factor.
We actually don't have any data on this because we have not tracked it for previous promotions. How will you figure out what to do?
Well, I think about a break-even calculation.
This candidate recognized that a break-even calculation is common in a case where you lack specific data and need to make a recommendation. For some candidates, this part is much harder, and they may not get to this answer as quickly. They may need to ask the caser questions to get to this portion that links the stocking up concept to the analytic questions.
To set up this break-even, A profit increase in a discount month is offset by a profit decrease post-discount due to stock up. Where these equal each other, we break even. Let's say this is a 1-month promotion. With 40 additional units sold 1 month, what's the maximum number of those 40 that can be stocked up so that we break even post-promotion? I mean, that's basically what I'm trying to solve.
Can you set up and work through this for me?
Sure. Let's call the number of stocked up units N. So N out of 40 will be the stocked up rate. We made $90 extra during the promotion and would break even if profit is $90 lower after the promotion ends. So plugging in numbers and solving, I know that post-promotion, our profit goes back to $4 per carton. Dividing the $90 profit decrease by $4 per carton means that N is equal to 22.5. So we break even if 22.5 of the increased sales are from stocking up.
Okay.
The candidates have solved all the lead-up questions and are now at the last step in the case. When they combine their intuition and the data before them, what do they recommend? Why do they recommend this? Let's see what some of our candidates have to say.
Back to my last question. What do you recommend?
I may be wary of a situation where we don't have a lot of information on a key driver like stock-up rate. I don't think it's unreasonable that most or even all of the demand changes come from stocking up. I might evaluate other innovation opportunities or maybe a smaller scale promotion just to compare before we launch.
That's reasonable. It's up to you to make the decision in this case. Can we talk about what information you'd like to gather to help inform your decision on how to grow?
This candidate took a more conservative approach. That's okay, as long as they can explain why. From here, the caser will challenge them to push their thinking and come up with ways to get behind a growth strategy. How might other candidates think about this?
I'd feel pretty good about doing this promotion. It just seems unlikely to me that more than half of the change in quantity would be stocked up. I'd recommend moving forward with this promotion and just keeping an eye on competition just to make sure we don't start a price war.
So you would go all out on running this promotion?
I'd run it on a smaller scale, maybe regionally, but I'd expect good results.
How would you structure that?
This candidate took a more bullish approach, and that is okay too.
I'd definitely like more information about what the stock-up rate would be. I know we don't have it, but I'd think about ways that we can get that. Either all the quantity change can be stocked up, or none of it can be, or it can be somewhere in the middle. Our break-even is near the halfway point, so I'd really like more information.
How would you go about getting that information?
We could do some research, or ask other firms. We might think about doing a small test. We can do that to limit cost and risks in a few regions or a few stores. We can look over those the next quarter and then make a decision on where to roll out from there.
So, you recommend moving forward, but on a small-scale testing basis, and then have plans to grow in the future?
Yes.
That's actually really interesting. Tests of this sort are something that we actually often do at Capital One. I'd like to hear you talk about how you'd structure this test.
This brings us to the end of this example analyst case interview. We hope that you found this example of conceptual setup, analytic problem solving, and forming a recommendation helpful. Remember to come prepared to think both qualitatively and quantitatively for your case. Ask questions, write key information, and explain everything as clearly as you can. Thanks for watching, and good luck.